One of the most widely watched and most important areas of economics and finance are definitely interest rates. Now, many people are probably aware we've got record low interest rates at the moment. A lot of people probably don't realise that we're now coming up to 2 years with the same record low rate set by the Reserve Bank. And the last time the Reserve Bank actually raised the official rate was back in November 2010. So you would think with rates so low that people would have no problem addressing their debts and keeping on top of their mortgage repayments. Well, there's been a few predictions in recent times that's showing a real concern for what's going to happen to a lot of ordinary Australian families when rates do start to rise. A few weeks ago, ABC News quoted an analyst who's predicted that if rates rise by even 0.15%, there could be up to 1 million Australian households at risk of defaulting on their mortgage. Just this week, the Sydney Morning Herald quoted a study that predicts that up to 1 in 8 Sydney households could already be under household stress. So to make sure you're not going to be in financial stress when rates do start to rise, whenever that may be, there's a few things you can do now. So number one, get on top and get ahead of your mortgage repayments. If you can build a buffer now, it's going to mean you'll be ready for when rates do start to rise. And it also means you're going to pay less interest over the life of your loan anyway. Another way you can be prepared for when rates rise is to go through your budget and your spending now and make cuts where you can. It's going to be too late when rates rise and you get a message or a contact from your bank saying your interest rate's gone up. So do it now while you've got the ability and while rates are still low. And another way you can make sure you're ready is to address your other debts. So credit cards are a real killer because interest rates are usually between 15 to 20%. So get on top of credit card debts once you build a buffer on your mortgage. So if you can make sure, number one, you've got ahead and got a buffer on your mortgage. Number two, you've gone through your budget and cutting expenses now. And number three, you've addressed other debts such as credit card. You're going to be in a much better position for you and your family for whenever it is that rates do start to rise.